You've probably heard about the Analyst Academy from Fundamental Edge by now. So instead of repeating the basics, let's talk a minute about what the Academy is and is not. The Analyst Academy is a practical course on the tools and skill sets required to succeed in the buy-side analyst seat. The instructors have experience from firms such as Maverick Capital, D. Shaw, and Citadel. But what is the Academy not? It is not a course on stock picking. It is a rigorous guide to learning and process. It is not a guide to pod shop investing. The Academy attracts a wide range of equity investors, from multi-managers to long-only to family offices. Rather than teaching a particular style, Fundamental Edge equips learners with the essential skills required to hit the ground running and support their PM. It is not a financial modeling course. Modeling is, of course, part of the curriculum and plays a central role, but the Academy is more than that. It teaches idea generation, thesis communication, and how to add value as an analyst. To learn more and access a 10% discount code, go to fundamentaledge.com/YAVP, or just see the link in the show notes. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this pod, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm going to let them introduce themselves in a second, but this is the team that won the Pershing Square Challenge. They're going to be pitching to kind of front run my intro. They're going to be pitching Valvoline. VVV is the ticker. They won the Pershing Square Challenge with this just a few weeks ago. And I believe they have the deck that they won with. I'll include a link to it in the show notes if you want to see that. So guys, I'll let you introduce yourselves in a second. Just before we go there, I'll just remind everyone, nothing on this podcast is investing advice. This is my disclaimer. Please do your own research, consult a financial advisor. I mean, these guys are first-year MBA students. If you're going to take advice from them, come on, you can't take advice from first-year MBA students. So that out the way, guys, first, congratulations. Why don't each of you just introduce yourselves, walk through a quick 20, 30-second background of who you are so listeners can get to know, and then we'll kind of start diving into the pitch.
Yeah, for sure. Happy to start. My name is Jared Duda, first-year MBA student at CBS. I'm from Pittsburgh, Pennsylvania originally, went to Oral Roberts University in Tulsa, Oklahoma for my undergraduate degree, and also did a master's at Vanderbilt. Before starting my career in buy-side research. So started my career at a long-only firm in Boston, and then was at T. Rowe Price for a little over 2 years before coming to CBS.
Garrett, do you want to go next?
Yeah, thank you, Andrew, for having us. Garrett Wallis here from Houston. Went to Baylor, got my CPA, spent some time at PwC, and then worked in advisory. And then spent the last 2 years in private credit before starting at Columbia. And then I'll be interning at Bias Seraphim this summer.
Perfect. Joe, you want to finish this off?
Yeah, happy to. My name is Joe Ferguson. I graduated from Vanderbilt University with a degree in math and physics. And after Vanderbilt, I worked at PwC as a consultant in their banking and capital markets practice. And I'm a first-year MBA student. And since I started at CBS, I've interned at a firm called Brizo Capital, and I'm going to be at Kane Anderson Rudnick this summer.
So I'm sure everybody's listening and thinking, God, these guys just have such terrible backgrounds. You know, how could does Andrew have any guest quality? Like these guys, just the scum of the earth. Maybe scum's not the right word. You guys hear what I'm saying. But look, why don't we hop into the pitch, right? So I think because there's three of you, I think we'll do this a little differently. Why don't we start and you guys can just walk through the pitch for Valvoline and toss it back and forth amongst yourselves as you do the pitch. And then I'll come in at the end and kind of try to earn my bones as a host. I've got a host of questions because not only is Valvoline interesting, I know several people who are long Valvoline. They've got the corporate M&A history, but I also know there are several other kind of franchise-driven brands that are loosely related to this that I have a lot of people. So there's a lot of interest in this space. I've got a lot of questions, and I think it's really interesting. But I'll toss it to you guys. Why don't you start going through the pitch?
Yeah, for sure. So I'm not sure what the exact price target would be now, depending, but whenever we pitched it, I think it's around the same ballpark. But we pitched Valvoline as a long with a September 27 price target of around $84 a share, and so that is roughly 95% price upside and a 22% IRR. And we think that the risk reward skews favorably at just over 3 times at these levels. And the high level on Valvoline, it's an operator and franchisor of vehicle service centers, primarily focused on quick lube and basic maintenance services. They sold their global products business in 2023 to Aramco, and now it's a pure play unit growth and comp growth type of story. So around half of their stores are franchised and the remainder are company owned.
And, looking back historically, Valvoline is a very different business today than it was for many years. Previously, it was a subsidiary of Ashland, where it really didn't receive the level of attention and focus that it deserved. And you can see management's recognition of this issue when they spun it out in 2017. However, the products division continued to divert management's attention until 2023, when that portion of the business was divested. So, today, investors have this unique opportunity to buy into a business that is not only performing extremely well, but has just really begun to benefit from the effects of a hyper-focused management team.
So, people want to know, how are you going to make money in this stock? And so we kind of have three main thesis points. The first one being this is a new focused growth engine. So as a pure play, we believe management will have the capital and the focus to really capture the white space that they see in front of them, as well as benefit from what we think are some secular tailwinds in the industry that are going to drive same-store sales. And then the second thesis point really focuses on terminal value. We think that EV euphoria is pretty overstated and the terminal value is underappreciated in this stock. And then the third point being the cash flow generation and the ability this company has to really be a compounding share cannibal. And so you add all that up, we think that drives a low 20s IRR over the next 3 years.
And double clicking into that first thesis point around revenue growth, specifically the unit expansion, they have around 1,800 units today, and we strongly believe that management will be able to hit their goal of 3,500 plus. Not only is the addressable market of oil changes large and highly fragmented, our research really points to a significant white space opportunity for new units. So what we essentially did was we scraped location data for Valvoline and the other quick lube major players, and then we analyzed the cross-section of that data with state vehicle registrations. And so leveraging that, and then assuming the current peak market density across the board, we kind of sized our lower bound for unit TAM, which was around 9,200 total quick lubes. And then on the other hand, if we assume that quick lube majors just dominate the do-it-for-me oil change market, we size our upper bound, which is around 26,000 quick lube TAM. And both of these figures far exceed the existing 5,000 units today, really underlining that opportunity for unit expansion.
So and then, I realized I said I'd come in at the end, and I'd love to just pause here and ask one question because I'm so excited, and this is one of the things that jumped out to me, right? So whoever was going to go next, come next after that, but just on unit TAM, right? Yeah. The growth. This is a unit growth story, right? We'll talk multiples and everything in a second, but this is trading at a mid-teens multiple. It's a good business. There's some franchise, there's some own, they generate lots of cash. I hear that, but you're really relying on earnings growth. And the way you're going to get earnings growth is this unit growth story. And I was just thinking, okay, I hear you. These guys, it's not like they have 75% of the quick change space and any growth is going to be tooth and nails. But at the same time, quick change has been around for 50, 70 years, right? It's hard for me to imagine there's huge white space in the market. And this is not Raising Cane's attacking the fried chicken market where there's rooms for different. Raising Cane's is fresh, never frozen. That's a little bit different than Popeyes. If I go to Valvoline versus a Jiffy Lube versus some other place, it seems the same. So I understand that they haven't taken a ton of the market, but it feels like how many places are there really that are dying for one more quick change place? So yeah, I hear they can take it and they're probably taking some share from mom and pops, but it's not like they can go plant 500 stores tomorrow and just, infinite white space. So how did you guys think about that?
Yeah, so the store density point with that.
Yeah, absolutely. So when we pulled this data and we looked at the state vehicle registrations, we also looked at population data from the census, and we essentially drew these 10-mile radius circles around each Valvoline. And then we found, we kind of summed them up and found an area where it was, essentially the highest density Valvoline location, where there's 21 Valvolines in a 10-mile radius. That area has about 1.1 million people on average. But then if you look at the least dense areas for Valvoline, where there's only, say, 2 Valvolines in a 10-mile radius, there's 0.8 million people on average. That delta between like 1.1 million and 0.8 million is not much. It means that they're starting to land in areas, or rather they've already landed in areas that they're really ready to expand in and start fortressing.
So I hear you there.
And the benefit also is it's also taking share story. So Quick Lube is 12% of the oil change market. DFIM as a whole is 56. And why you go to a Quick Lube versus a competitor, which will be like a regular auto body shop or a dealership, is just time. I mean, the dealerships are trying to go to a more quick service model, but it requires now a drop off, take a loaner, and then come back, as opposed to people that just want to get the oil changed in 20 minutes. I think that's why these guys are taking shares, and they continue to take share from the dealerships.
Is 20-minute oil change?
Oh, sorry. I was just going to say, like, it also seems like you're handing on like the structural growth of traffic going forward for some of these boxes. And I think like the key secular trend that matters here is that DIY to the do it for me shift. And we're going to talk about this later whenever we talk about the same store sales growth, but that divide tends to be drawn on income lines, and people with higher household incomes are much more likely to outsource their basic car maintenance. And just based on demographic data and which cohorts of the population are growing the fastest, I think as Gen Z, millennials enter their higher earning years, I think that's like a structural support story for that, for DIFM to continue capturing share from DIY. And there's runway to do so, given that DIY still has 40% of the market today.
I'm quite surprised that DIY is 40% of the market, but I am really surprised that do it for me, which is, you go to your traditional auto shop and they take 4 hours with your car. I cannot believe that is 56% of the market versus 12% at Quick Lube. Like I just don't understand it. How is it kept that big of a share?
It's just not that there's not that many locations, and yet I think about who the competitors are. Like if Jiffy Lube is the main big competitor, but it's a subsidiary of Shell. So we really focus on the fact that Valvoline has a pure focus now on a growth story. And then your only other pure play competitor is probably a Take 5. Grease Monkey, Take 5. You got like 6 other business units wrapped up in there.
Within driven brands, Take 5 is a pure play oil change, but there's Grease Monkey, Express, and like a lot of small, like kind of tail end franchise concepts for that. But going back, like there really aren't a ton of scaled Quick Lube national franchise businesses like Valvoline.
Yeah. And Valvoline,
go ahead, Joe.
Yeah. And Valvoline hasn't been doing roundups on the franchise side, until maybe like the past 2 or 3 years. So that story is also relatively new and has yet to fully mature, I suppose. And for them to start really leveraging the franchisee dynamic that they have to drive that unit growth is just starting to play out.
So I guess if I came back to my question was like, hey, it's not like oil change is new. Why isn't the space already well taken over? And your argument would be, look, yes, there are lots of places, but as you said, quick change is only 10% of the market. So there's this huge, you should have ongoing trends. I can't believe it's only 10. You should have ongoing trends as both do it for me and especially the traditional go. And, if it goes from 10 to 30% of the market, there's a lot of room and there's going to be a lot of space to put in a lot more Valvoline stores, a lot more Jiffy, like whatever it is, there's just going to be a lot more space. Is that kind of the answer?
Yep.
Perfect. All right. Thanks for letting me hop in. Please continue with the pitch.
Sure. So we discussed the white space opportunity and then, that it's quite large, addressable market, highly fragmented. But we thought about, what is the box that we're putting in this white space opportunity and how attractive are the unit economics? And Valvoline truly benefits from attractive unit economics. In reviewing the FDD, we looked back over the past 5 years. Valvoline, over this highly inflationary environment, was still able to CAGR profitability at a rate faster than sales. Specifically, EBITDA was CAGRing at 9.8% and sales was CAGRing at 8.6%, which is pretty impressive. And then we also estimated the unit economics going forward over a 5-year forecast period for a single Valvoline. And over that period, we estimated a 23% unlevered IRR and a 45% levered IRR, which we also found pretty compelling. And then after thinking about the unit economics, we discussed this a little bit here, but we thought about the competitive, whether Valvoline has a competitive advantage to really seize that white space opportunity, capitalize on it, and move faster than their peers. And we think that they do. We think they have, strong, building blocks of a competitive advantage. First, Valvoline, it's singularly focused versus its peers, which are either distracted, they're subsidiaries, they have other concepts that they need to tend to, or they just lack access to public capital markets to fuel that expansion, like Grease Monkey, as we mentioned. And then second, they've been investing heavily in their teams and technology in meaningful ways. They have a new head of real estate. They have a new CRM system to take advantage of the fleet opportunity. They have model-driven site selection that seems to work out quite well based on the research that we've done. And these are not just soft factors. They play out in the numbers. On a unit level, they're ahead of their peers on average in terms of AUV by 39%. Then in terms of car volume, they're ahead of their peers on average by 32%. And this, we really see as, operational excellence at Valvoline that their peers seem to lack. And then lastly, they have this, really awesome franchisee dynamic where they have a number of large, highly capitalized franchisee partners that can obviously drive unit growth. But then they also have many smaller franchisee partners that still operate at scale to fuel unit expansion. I think the median store count across their franchisees is about 5, whereas for their competitors, it's about 1. And so that's just a franchisee dynamic that, none of their peers can really compete with.
Yeah. So kind of going back to the top line now, Valvoline has consistently posted high single digit to low double digit comp growth, even before COVID. And, I think high level, we believe that there are underlying traffic and ticket drivers that can help sustain this. And while pricing will roll over and they were obviously in an inflation, they benefited from that. There are still some structural kind of drivers there. Sorry, I messed that up. We can edit that out later. I guess going, back to the traffic that we discussed, for traffic, the key secular trend, as we mentioned, is the DIY to the do-it-for-me shift. And that DIY divide tends to be drawn at income lines, as we mentioned. People with higher household incomes are much more likely to outsource their basic car maintenance. And based on demographic data and survey work, we do believe that do-it-for-me is poised to continue capturing share from DIY and has plenty of runway to do so, given that DIY still has around 40% share of the market. And then again, as millennials and Gen Z enter their higher earning years and migrate to do-it-for-me, they should support, sustained 2% traffic contribution at least for Valvoline boxes going forward. And then going now to ticket and the drivers there, so for ticket and mix, the first driver here is around non-oil change services and fleet services. And these are small but rapidly growing parts of the sales mix today that are highly accretive to overall ticket. And the fleet business in particular is a focus of the new CEO. Serving these customers comes with 20% higher ticket on average and drives more store throughput. And while still early innings, even just simple initiatives like building out a CRM system to understand and capture this fragmented market, already showing some positive results year to date. I know that there was a little hiccup this quarter with it, but I think we're confident so far. We haven't talked to management yet about it, but I think a lot of these issues should be mitigated in the near term. And then now going back to the other ticket drivers on premiumization. And so, it's around as more vehicles in the car park require higher price synthetic oil, it's kind of a natural uplift. It's a natural uplift for ticket. And, there is a debate around whether or not the pricing benefits of shifting to synthetic oil would be offset by the theoretically longer oil change interval times that come with synthetic. But at this point, oil change frequency is ingrained in consumer behavior, and volumes really haven't been affected. Our primary research supported this view nearly unanimously, by the way. And motor oil still degrades over time. And if anything, I think people are more willing to get their oil changed more often, or at least on a normal or on the historical schedule in order to maintain their more expensive vehicles. And kind of in summary there, while we do expect store growth will drive the majority of future system sales growth, I think that the key traffic and ticket drivers are still intact and are able to support that mid to high single digit comp growth algorithm going forward.
Thanks, Jared. I'll pick up on our second thesis point. So the second point's all about, EV risk and how it affects the terminal value. And we really break down the EV risk into 2 components. The first one being, what does the ICE car park look like over the next, decade or two? and then how can management address the EV car park. So on the first point, as far as ICE car park, we can look at, forecasts and assumptions of what EV penetration looks like. We have the EIA saying it's 12% by 2050, and you have Toyota out there in the market saying, oh, EVs are going to, cap out at 30% of market share. And so we took those two numbers and really kind of focused on Toyota's. Like, let's say just becomes the worst. It's 30% penetration by 2050. If you assume just a historical growth rate of the car park of the last decade, which is about 1% going forward, at 2050, the ICE car park will be about 5% below today's level, which is not that much, not too material, but it's also important to recognize it's not a straight line to that point. And when we do an analysis of the ICE car park to that time using accelerating EV sales and normal scrap rates, the ICE car park doesn't actually fall below today's level until about the late 2030s. So we feel pretty safe with our terminal value assumption, especially when you consider what those ICE car parks imply as far as TAM. So, on a 30% penetration, we're looking at like a 16,000 quick lube TAM, and we're currently at 5,000. So there's still way more room to run on that front. And and it's important also to note that our thesis isn't focused on the market coming our way as far as EV risk. We kind of see EV sentiment as the perma bear who's called 10 of the last 3 recessions. He's going to be right at some point, but in the meantime, who's going to accrue the profit? So that's really how we look at it. And so flipping to the second part of that EV aspect, we think right now we're also seeing a little bit of rationalization around the EV euphoria. That initial cohort of EV buyers has started to mature. We're seeing really a full life cycle of the product, and people are starting to realize that there's more to EV cost of ownership than just the fuel cost savings. And so that high price tag and short useful life of the batteries has a real direct impact on the residual value of these vehicles, which we're seeing is driving, higher financing costs, higher insurance costs, then lower than expected resale values. So there's some real economic hurdles that need to be cleared here on this concept. And just to finish off that thought, management recognizes what's coming as far as EVs, and they're not waiting to be the last horse and buggy in town. And so what they recognize is the value of this business at the end of the day is not that they can do oil changes. It's that they have a network of conveniently located dense boxes with bays and technicians. And so how do you leverage that into the future to take advantage of the EV penetration and the EV proliferation? And you do that through making services applicable to EVs. And so management's already kind of piloted that program, trying to figure out what services EVs will still need. They still need tire rotation because the tires go out faster because they're heavier. They do all the non-oil change stuff like wiper blades, battery replacement, and stuff like that. So they're trying to get in front of that. And we also have the transition aspect of hybrids, which have continued to accelerate in sales, really pacing or outpacing EVs. And those have the same oil change servicing needs as fully battery EVs. And so management's really taking advantage of that.
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of that year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Training on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick. Then he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast-track your career on the buy side. Find out more info about their next cohort at fundamentedge.com/YAFP, or just see a link in the show notes. I had some questions, but I'll wait because I think the valuation point will help with the questions. Though I was just going to say, when you said people are starting to see the cost and the resale value, like go ask Hertz, the rental car company, who kind of went all in on Tesla cars in 2021, and people can pull up the Hertz stock, and there's other stuff going on there, but they are ruining the day. They went all in on the electric vehicles. Did somebody want to wrap up? I think we're getting towards, I'm just looking at the deck. I think we're about to hit valuation, and then I can come back with some of the questions. Yeah,
I'll just hit the last thesis point real quick, and then we can roll into valuation. So then the last thesis point is this is really high cash flow generation. So it's all about continued capital allocation and the discipline of that. Management's proven that they don't waste cash. They've returned as of this quarter all of the cash from the sale, and all the analysts are hitting them with when do buybacks come back. And they've iterated, once leverage is in line, that they're going to start the buyback program again. And we're forecasting over the next 3 years through 2027 that they can buy back almost 20% of the outstanding, which is going to be a really great driver of returns and EPS growth going forward.
Right.
Yeah.
Go ahead. Just to add on to that, and I guess state that essentially because of their commitment to returning cash to shareholders and their robust economics, it really positions them to become another industry cannibal like AutoZone and O'Reilly, who have substantially grown net income while strategically repurchasing shares to fuel share price appreciation. And frankly, the precedent that they raises our level of confidence that Valvoline will be able to do the same. And moreover, their compensation structure, management's compensation structure, with its shift back to EPS-based incentives going forwards, further supports these shareholder supportive actions.
And so just tying all that back into valuation and kind of roughly, again, that September 2027 price target of around $84 a share. And so kind of the base case algorithm, on 24 to 27 CAGRs that allows you to get there is roughly 10% store growth, kind of 7 to 8% comp growth. So it's 15 or 16% top line growth, around 27% EBITDA margins with high 20s incrementals. So we really don't underwrite a ton of margin expansion. And that kind of flows through, including the buybacks, kind of that mid-20s EPS growth algorithm. And so, right now we're ahead of the street on all metrics and kind of near the high end of management's long-term stated algorithm. And, kind of going back to that price target evaluation, I'm sure you'll have more questions on this, but we arrive at that using, 21 times forward PE multiple on our 28 EPS estimate. And so this translates to roughly 14 times forward EV to EBITDA multiple on our capital structure assumptions. And again, as we mentioned, I think that the risk reward is attractive here, just above 3 times, based on these base case assumptions, and then assuming nearly 30% downside in our bear case.
And we didn't consider this point in our scenarios, but we do believe that this business offers significant optionality that proactive investor could take advantage of to increase returns. Not only could Valvoline refranchise its corporate-owned stores, but it could also relever. Thanks to their conservative balance sheet today, their history of same-store sales growth, as well as their strong free cash flow conversion, we think that 2 turns of incremental leverage could yield $1.4 billion in incremental value, potentially in the form of a dividend recap.
And I think that would take them from 2 times levered to 4 times levered, if I'm looking at the numbers roughly.
Yeah.
Yes.
And if you think about the leverage levels that other similarly franchise concepts run at with similar free cash flow conversion, kind of in the high 70s, low 80s, I think that you could easily take this thing up to 3.5, 4 times.
Yeah, 100%. I mean, I don't have any off the top of my head, but most franchisees now, this is not fully franchisee. I don't think they disclose the mix of franchise versus
it's half and half. It's roughly half and half.
But if you think about most franchisees, they get 15 to 20 times multiples if they're running well, and most of them run 5 times leverage is about 33% of the debt to equity stack there. It's not uncommon. It's actually pretty common. If you're a franchisee's business, you should be reasonably low cyclicality, huge cash flows. Exactly what you're saying. I would not be shocked to hear it. Anything else you want to do, or should I hop into some questions?
You can start questions.
Joe, I'm glad you mentioned the AutoZone comparison, because people are going to hear this, and that's where my mind jumps to. You've got a capital light, car focused consumer business that's buying back shares with basically all their cash flow, and they've got a lot of white space. I hear that. The 2 places I want to ask, first, AutoZone, from memory, they're dealing with thousands of different parts. And because it's thousands of different parts, they had a natural advantage over mom and pops, because you're buying, if you can buy 1,000 parts over 1,000 different stores, you get better pricing than, maybe one store, maybe deeper inventory. I don't see what the advantage of a corporate Valvoline versus your mom and pop, because so much of the cost is going to be the box, just the real estate value, and then the labor, right? That's what's so much of the cost going to be. And then I guess I'll just throw my second thing in, because it kind of hits on that. The other places where franchisees really work, especially in restaurants, right? Where there's a lot of benefits to national scale, better advertising. You can do advertising over more. You guys talked about kind of the fortressing of where you put multiple stores. You can get that. So there's some benefit there, but there's national advertising. And with restaurants, today, there's a lot of benefits in having a consumer app. And if you're a 1-unit franchise or a 1-unit store, you can't match the McDonald's benefit of this consumer app, to say nothing of having like the touchscreens and everything. And I don't really get that with oil change. Like, I don't know how much an oil change consumer app is going to drive things. I don't understand the benefits of like a national scale franchisee. Why, Joe, Garrett, Jared, when we start our own oil change, like, why are we writing a check for royalties to Valvoline every day instead of just having I'm trying to think, Gage, instead of just having the GAJJ auto change? Like, what's the benefit there? So I threw a ton out. However you guys want to take that, I'll let you take it.
Sure. Yeah. I mean, I think that, in terms of having a really dense network of stores, it does save in terms of the marketing expense that's able to be spread across more units. Valvoline is also very, very far ahead, I think, against their competitors in terms of collecting data on their customers. And they use that to essentially improve their staffing at the locations. And so they're able to get some labor leverage when volume goes up, and they're able to staff appropriately when they expect volume to do so or when it's down. So this is important. But, we've spoken with franchisees in the past, and they talk about, how do they do better than, say, your mom and pop shop down the road, or whatever one we're about to create. It's because they go in there and they're able to adjust the pricing effectively. They are able to manage the accounts better. Frankly, they say that some of the mom and pops out there are just not really very well run businesses. And the Valvoline Super Pro management system, which is a turnkey system that they've just spread out across, all of their franchisees. Whenever they have an update, it goes out pretty effectively. That really does drive the operational excellence that we see in the unit outperformance, not only versus mom and pops, which we expect there to be massive. It's still well beyond, Driven, Grease Monkey and the other competitors as well, in terms of that car volume coming through each store. And I'll just touch on this, last point here. You mentioned complexity, for AutoZone. There's a lot of different SKUs. And I think people think about a Valvoline unit as just providing oil changes. And of course, that is the primary product. 74% of the revenue comes from oil changes. But they have, I think on average, and this is from our data scraping exercise, on average, they have maybe 12 or more different non-oil change services and products essentially at their locations. So the box is a little bit more complex than one might think, and they're still able to drive throughput despite that. And they're actually looking to make it even a little bit more complex as they try to tackle the EV problem, as they try to roll out battery replacements and more complex inventory intensive services that, you just don't have, at these mom and pop operators, or they're not run as effectively through them.
And I think who's better positioned to win on that front, like in the EV transition and the capex required to purchase more expensive machinery to provide these services or things like that, or having the bandwidth to train all these employees and upskill them. It's going to be the big franchise concepts that have established systems. And I think going back to like the Super Pro system too on the labor front. It's much easier to plug and play, kind of this lower skill, for lack of a better phrase, higher churn labor. It's easier to plug that into like an already established like franchise corporate design system, I think, than having to deal with that more transitory nature, if you're running a mom and pop store.
And this kind of also dovetails into a question you got to your Twitter post. Was you sign up to a Valvoline, or for that case, even a Jiffy Lube compared to others, because of the relationship they have with the product provider. So when the divestiture happened from the products business, they struck a deal for the oil that's on a dollar margin basis, so not even a percentage margin, just a dollar margin basis. So as a franchisee of Valvoline, you have access to what I would consider probably a less volatile product stream as far as the cost, which would benefit you as compared to maybe like a Grease Monkey or Take 5, where you don't have that kind of direct access.
And just a quick question: is there? If I'm with Valvoline, like obviously they've got hundreds of stores, can they do an oil change faster than, obviously they do it faster than me because it would take me 5 days and 100 YouTube videos. But if we were running a mom and pop, like does Valvoline, just the training, maybe a little bit of, I don't know if AI is the right word, but does the training and the enforced practice, can they do an oil change in like 7 minutes where it takes a mom and pop 12 minutes or something?
I don't think it's the actual change of the oil difference. I mean, they have it set up to be changed very quickly. Like that's what they do when you come in the bay. I think the real difference is that when you go to a quick lube sole provider versus a multi-care provider, it's the line and it's what's in front of you. So if the guy in front of you is getting like 9 other things done, it doesn't matter how fast they can do your oil change. And what Valvoline is like, it's really focused on oil changes, which is I think why you see that they can do like 52 cars a day. And then the average for the competitors is more like in the 40s. And like Jiffy Lube has a much broader multi-care model where they're not just doing like tire rotations. They're doing brake replacements and things that take much more time. So it's not even a question of just the oil change time. It's a question of what else is just being done in front of you.
Perfect. Let me go to, I want to come to value, but let me go to the other thing, because the thing that jumped out to me, you guys addressed it well, it's going to jump out to everyone, is the risk. If we were in Elon Musk's dream world and 3 years from now, everybody's doing electric robo vehicles, the risk from the shift to electric vehicles, and you guys address it well, but I just want to come at it from a different angle, right?
Yep.
So I was just doing some Googling, and I've studied the refiners a lot. So you have similar risk here. I was just doing some Googling. Last year, about 7.5% of the cars sold in the US were EV. And then another 7.5% were hybrids.
Yep.
And of the car stock, the overall amount of cars in the US, only about 1% are electric. So I hear what you guys are saying, but if I just think about EV, I mean, it might drop this year because I think consumers are a little disenfranchised. But if I just thought about for the next 10 years, all EV sales are going to be 7.5 to 10%, with the hybrids, whatever. That's going to eventually take a lot of cars out. And you guys were talking about the cars flipping in late 2030. But if I thought about the math I just laid out, like to me, the ICE stock is actually dropping 1% per year over the next 10 years, if I'm just kind of doing that rough math in my head correctly. So I just want to talk a little bit more about the EV risk and like, why is the math I'm doing there silly versus I did that math on 2 Googles in 5 minutes. I know you guys spent a lot more time. Why is my math wrong?
Well, because you also have to account for the actual car park growth. So if you look at 2010 to 2022, car park growth was about 1% per year. And one of the main points that we were kind of poking on around the shift to DIY to DFM is that if you break down what we call like the driving age for this argument, it's like 15 to 70. The growth going forward over the next 2 decades is really driven by who is currently 15 and 30 today. And so that's where that generation right now is much larger than its predecessor. And so the next 2 decades, we're going to CAGR the car driving age at twice the rate as we did in the prior decade. And so when I take a 1% historical rate going forward, I think I'm probably being actually a little conservative. I think car park will grow more than that. But you also need to account. So I think our numbers were we start 15% EV sales going forward, and we just crank that up until it's like 40, which gets us 30% penetration in the back end. And when you have normal scrap rates and the car park growing at 1%, the ICE car park will still continue to grow because it's not a 1-for-1 replacement. And there is EV scrap and stuff like that because EVs have been on the road for, at least a decade. And the EVs we're talking about here is the 7.5% EVs. It's the fully battery. So the way we ran the math, it was not a 1% decline starting today.
Do hybrids need oil changes at the same level as a traditional car?
Yeah, if you look at the stated oil changes, it's like 12,500 miles, which is what technically a premium car should be, or premium lubrication should be. And the number just bears out that no one is following that. So and that was an interesting thing because, one of the things, again, maybe because I was having a refiner focus, I kind of thought, okay, like cars in the 70s had 12 to 15 miles per gallon or whatever. And today the average car has, ignoring hybrids, 25 to 30 is kind of standard-ish. People can hit with the math, but directionally correct. And I was kind of thinking, hey, is there some risk where, when I got my car in college, I remember it was like, hey, every 3,000 miles, go get your oil changed. And then are oils and lubes better today? Cars better today where it could be 10,000. And I think what you guys are saying, yes, but the consumer behavior around 3,000 is so ingrained that they're doing that. I want you to build on that. And then I would just throw out, do you think it's because I remember like right in my windshield, they would put the guy when I was leaving, he'd put, hey, here's the reminder for your next oil change. And would be a little sticker. Like, if I was at 3,000, 6,000 come in. Do you think it's a little bit like the Valvolines and everyone can nudge everyone because they, never ask your barber if you need a haircut. When you leave, they say, here's when your next oil change is. And everybody's just kind of a slave to that. So I'll, again, threw a lot out you. I love to ramble. I'll let you guys address some of those. I can start it off, and then Jared, you can finish it up. I think the risk reward for not changing it is just so terrible. So I can spend $100 this month, or I can spend $3,000 to get my engine fixed. And when you look at the FDDs from a Valvoline, and you look at what percentage of the services is the premium lube versus the conventional, premium has gone up materially in the last 3 years, while visits has also increased. So you're not seeing the change there. We've talked to operators. They're like, it's 5,000. When you take miles driven in the US and then you back out what average miles are per car and how many DFM oil changes there are, it gets you to the same 5,000 mile number. So kind of any way you look at it, there hasn't really been a shift in consumer behavior. And then the big automakers are already walking back their oil change interval recommendations.
Yeah, kind of adding to that, Garrett touched on a lot of the main points there, but yeah, again, like you have consumer behavior is entrenched. And again, if you're spending, $35,000 for like a base model vehicle today, it's like you're almost willing to spend more, on that preventative maintenance aspect in order to preserve the value of your investment, especially since, average age of cars in the car park is increasing. People are holding I think there was an article in the Wall Street Journal even this week talking about how people like the math for new cars just doesn't make sense and people are keeping their cars longer and longer. I think, again, there's more of a focus on preventative maintenance. And yeah, to your point, I think there is definitely that psychological nudge, from the Valvolines and the Jiffy Lubes to kind of get your oil changed more frequently.
If you think about it, it's not just the Valvolines who incentivize. I mean, even the car manufacturers, even if they're saying, hey, you can change it, they're incentivized too, because where do most of the oil changes place? They probably happen at like an auto dealer attached shop. So they're kind of incentivized. Everyone's incentivized to keep the nudges and keep people coming in. So it is interesting.
Incentives from a warranty perspective or anything like that.
Yeah. Cool. Let's go to... I just want to ask on franchisee. We talked about why a franchisee would want to get associated with them. You get a better oil deal, you get some branding. I mean, there is some fortressing to the franchise. Like I remember New Orleans, where I'm from, the Pelicans, all the sports teams are sponsored by the local, like a Jiffy Lube or a Valvoline or something. So it's silly, but that is a sponsorship and that is advertising that you're not going to get at mom and pops. So there is some of that. I just want to franchisees economics. You mentioned that the average franchisee here owns about 5 units. That's starting to broach from like the 4 of us pool our money together or mom and pop owns it. It's starting to get more into like professional private equity franchisee. Obviously private equity, much smaller private equity, but it's starting to get into that area. The past 18 months have not been super kind to them in terms of just interest rates going up. How do you guys view the health of the franchisee system here? Because if I can just keep that is one thing. Like I'll hear people toss a franchisor out and they'll be like, oh, it trades at 8 times EBITDA. And my first thing will be like, yes, it does. But their same store sales are negative and all their franchisees are going bankrupt. So, 8 times is going to 800 times really quickly. How do you look at the health of the franchisee base here?
Yeah.
So go ahead. And I was just talking about I think a strength of Valvoline is that they have, more of an institutionalized franchisee base. It's better capitalized. It's drawing that comparison to restaurants again. I think for a lot of these unit growth and comp growth type of stories, what the company has the most control over is a unit growth. And we already talked about the unit economics are attractive for these boxes, but and really what's going to drive system growth? The majority of that's going to be unit growth. And I think some of that is de-risked more when you have a network of smaller or a fewer but better capitalized, more institutional grade franchisees, as opposed to relying, on your mom and pops. And I think about it like for restaurants, typically unit growth, or not typically, but a lot of times that the store growth in kind of foreign countries where there's 1 or 2 master franchisees partners is almost more de-risked than what it is if you're dealing with a network of long tail mom and pops and on the domestic side.
Yeah. And then
thanks, Garrett. Just to add to that, Valvoline does of course benefit from that incremental marketing. They have some they're able to leverage some of the data from corporate, but they also leverage a model that helps them drive site selection. So the franchisees work together with corporate, and it does seem that this model is better than the ones that the competitors have. And I think that this does contribute to the franchisee health. So, we did like a sampling across like 500 different locations. across the concepts. And Valvoline benefits from like an incremental 100 bips of population growth that the competitors don't have. And I think, yeah, that's just incrementally beneficial to that franchisee health.
And to your point on just health and then rates, because we got this question in the actual competition as well, is that the unit economics are so strong that you really have a lot of headroom if you were to lever up this business or run it levered. So when we talk about 20% unlevered IRRs, it's like that's assuming a 6 times exit. If you just look at ROICs in the out 5-year maturity window, it's really high 20s ROICs on the investment on an unlevered basis, which is really interesting. And then for the franchisee aspect of it, we actually spoke to an operator that has I think around a triple digit network of stores, and they are trying to add more stores as quickly as they can. It is such a good business, and the unit economics are so strong. They are adding stores as fast as they can. So I don't have too much concern on that side. And then as far as how rates tie into this and the unit growth story is when you look at where these boxes go and the competition for that land on the corner next to a Costco or wherever you want, next to something else, it's going to be the box that has the best unit economics. And so when rates come up and there's the competition for those areas of land get more tough, it's not another crumble that goes in that box. It's who has the highest and best use for that land. And with 25, 28% ROICs, I think Valvoline has a really strong bid to acquire those new properties.
Garrett, you mentioned the refranchise angle, which is one of the angles I like, and it doesn't, it's the Pershing Square challenge. I think Ackman is the judge here, and one of Ackman's earlier campaigns was going at McDonald's and telling them to refranchise their store and doing a very similar math to what you guys did. And I wonder if he, this would check a lot of his boxes, and I wonder if he was taking notes like, I have 2 more questions and then we'll wrap up. You guys people can see, I think you said you're going to make the slides available. Slide 16, you've got your bear case. Before I start diving into more bear cases, I just want to ask, what is in your bear case that you guys laid out? Not the numbers, but the thought process behind it, if that makes sense.
Jared, you going to take that and I can follow up with anything?
Do you want to go ahead? I'm going to pull up the model, actually.
Yeah. So the bear case, I think the real risk here, like with the unit growth story makes sense. There's white space. They have cash flow. They don't need debt to go out there and get it. So if they want to grow, like they can grow. They just brought in a new development team that has the capacity for 100 company-owned stores, and then the rest being pushed off in the franchisees. I think the risk here is really the same store sales story. Management's calling for high single-digit same-store sales, and we're modeling 8% same-store sales, which is funny. As we practice this and we pitch this everywhere, no one asked us about that. That was just people just accepted that number. And
no. Someone, that was my last question. So someone was going to ask you about that. Don't you put that evil on me, Ricky Bobby.
So I think that's truly the risk. And I think we lay out a good story for why it's not crazy. I mean, there is a pricing power element here. As prices go up, just in base level oil effects, like the prices are sticky. They go up and they stay up. We have a good traffic shift coming in from millennials and Gen Zs just earning more money. And that's who's, 60%, apparently 60% of Gen Zs changed their own oil, which is shocking. And then you have the NOCR and you have the fleet, which they're kind of going after. And so that all can build up to that, 6 to 8% same store sales growth. But if times really do get hard and the consumer really does get constrained, is that really reasonable? Does that kind of come down to that 2 to 3 range where you're really just kind of taking price and getting a little bit of mix shift? And I think if I remember correctly, Jared, that's kind of what is driving our same store sales. We're bringing that same store sales down to the low single digits range.
It kind of in that number is like the actual comp number for a downside case. It is kind of assuming that this thing comps in line with kind of lower growth, with lower growth.
Did we lose Jared? Can you guys hear me, or did?
I think so. Just a little bit. Yeah.
We lost Jared. Okay. Yeah, Jared, you went on mute. Let me ask my question, and Jared can hop in if you want.
Yeah, I hear you.
Yeah, go ahead, Jared.
No. It's just basically, that downside case for the comps assumes kind of that comps are in line with inflation, and then you have that negative reflexive impact of when the unit economics aren't as good, store growth will probably start to slow going forward, and kind of gets you down to that. But you're still going to have potentially an assist the buyback or capital allocation there, or I want to check that comment actually. But again, just kind of that 30% downside, I think is reasonable.
So on the growth here, right? Like you guys, your model is roughly 15% annualized growth going forward. And of that, let's call it 60. We can split it just to make the math easy. Half of it is unit growth going forward, and half of it is, as you said, same-store sales growth. And in the same-store sales growth, there's the premiumization, which I actually kind of believe. Then there's pricing, and there's traffic growth. And of that growth, it's kind of split a third. And I guess my two questions would be, number one, traffic growth, because the limit here seems to be, we talked a lot about putting more, when we were talking about the franchisees, you guys were saying, hey, they can get 52 cars through per day versus mom and pops are kind of in the mid 40s. I wonder if they can really do traffic growth. Like, aren't you eventually limited just by kind of the box size and your employees' time? Like, can they really keep growing traffic for 2 to 3% per year? Because if I said roughly they're doing 10% more turns per day than their competitors, like, look, if you had 20 bays versus your competitors at 4, of course you can, but I just wonder if they're running into just the limits of human time and how quickly you can get these done.
Yeah. So I think on the traffic point, and you saw it in the last earnings call, it has to do with the utilization of the bays. And they really talked about going forward, doing a modular design to their buildings, because the third bay doesn't really get utilized until closer to year 4 or 5. And so I think that might be a way to, kind of address the comment you made that, going past 52, can they really do it? But just on top of that, I don't think 52 is the end all be all for this, because a lot of what we're also talking about on traffic is going to come from hopefully the proliferation of fleet services that is done not during quote unquote office hours. So running more cars through when it's kind of closed up to the public, and that really, drives higher ROAs for the current asset base.
Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as the guest speaker series, which recently featured Rich Wallis of Arcana, who discussed the role of factors in fundamental investing. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. Fundamental Edge recently hosted its first Analyst Spring Training Conference in Scottsdale, Arizona. Attendees enjoyed a range of speakers, judged a stock pick competition, and networked with fellow alumni. Mark your calendars for the spring of 2025 for the next conference. Visit fundamentedge.com/YAVP or just see a link in the show notes for more information about the next Academy cohort. Well, that relates well to my next point, pricing, right? Because my two pushbacks on pricing would be, like, they did over the past 2 years almost 5% pricing. And my two pushbacks on pricing would be, A, like the past 2 years, you had lots of inflation. So I think they were getting 5%. And you guys are not modeling 5% going forward. You're modeling more 2 to 3%. But I would think, like, this seems like something that gives back a little bit of pricing if wage inflation and energy inflation come down. That's just my gut. It gets competed away a little bit. And then B, if you're going premiumization and you're doing fleet deals, and the fleet deals, they're bringing their fleet, and you've got someone working it overnight or in the morning because you're just leveraging it. Like, that is great for your ROAs, but I would think your pricing is going to have to come down, because a fleet is going to go to every shop in the area and say, hey, we're going to, this is incremental to you. This is great. You're utilizing your things during off hours, but we can go to everyone and we'll go to whoever's the cheapest. So is pricing going to come down as you get more fleets going?
Well, so far management has said that fleet comes with that 20% higher ticket. And we obviously don't assume kind of that level going forward. And we do recognize that pricing is definitely going to roll over. Like, it's going to moderate. Like, you're going to have people probably be more aggressive on promotions again as other competitors are building boxes. Like, that pricing is not going to be there forever. But historically, when oil prices have ebbed and flowed, they haven't given all that pricing back over time. Like, there is an element of pricing power to this business, just given, going back to those building blocks of competitive advantage that we talked about previously. So, again, like, we don't assume the same level of pricing going forward. And, but again, like, they're not going to give all of it back.
Yeah, I think
and if it's helpful,
you got it, Joe.
If it's helpful, I mean, in the latest earnings call, they talked about how they just started to look into data associated with, individual customers and their, socioeconomic backgrounds, like the low income individuals, based on their data analysis, have not started to pull back despite high inflation. So they're still returning at the same cadence, and they're not losing customers, which I think means, that they do have a little bit more pricing power than one might initially expect.
And then just a final point on the pricing power for fleet. I think there is a lot of value for these larger national fleet customers in partnering with a national fleet servicer. And there's only one, and you say you go shop it around, there's really only one other player in the market, and that's Jiffy Lube, that has the same scale. And we've talked to their operators, and they're not going after this space. The quote is, nice to have it, haven't gone after it. Because it's not a focus of corporate, and so it's not being pushed to the franchisee base, which is they're all franchisee. And what you have here is a large corporate 50-50 that has put a CRM system in place and is going after that, and it's going to come to the benefit of themselves as well as the franchisees.
They are 50-50 corporate franchisee. Do you think I don't see a lot of things that settle at 50-50. You generally either go, Chipotle, Starbucks, all company owned. And they would say, hey, we're better company owned because we can protect the brand, enforce standards. Or you go the other way and you go Wingstop, all franchisee, right? It strikes me as a little strange that they're 50-50. And Garrett, you were just kind of saying, hey, that's good because with a lot of corporate, they're a little bit more focused. They can think a little bit about going after fleet, but you still get the franchisee model. I would guess, do you guys think they have to kind of pick a path and go one way or the other? You guys have obviously argued for upside if they went all franchisee, but do you think the status quo can hold here with the 50-50?
I think our base case models a slight increase in the franchise mix of the store base. So, over our forecast period, I think today, and Garrett and Joe, feel free to hop in, but I think today, the unit economics of these stores are still really good. I think if those degraded maybe more over time, maybe it's better, maybe the unit economics, being a franchisee is better. Maybe that changes over time. But I think today the unit economics are still so compelling that you almost want to own some of that, if you're Valvoline corporate.
Look, Wingstop, we're all franchisees and it's great. The stock trades at 200,000 times price to earnings. But you do wonder, hey, if the franchise economics are so good, shouldn't you want to capture some of that? And
exactly.
I hear you. If you're getting 20% unlevered IRRs from opening up boxes, why not just go do it yourself and capture it? Okay, last question. I think the one thing that people are going to say here is they're going to look at this and they're going to say, okay, we mentioned the AutoZone comp. Everybody wants the AutoZone comp. These guys pitch a great story, unit growth, all this sort of stuff. This trades at 15 times EBITDA, 27 times price to earnings. I'm just using this year's guidance, right? Mm-hmm. And I think people are going to have a little bit of sticker shock where they're going to say, okay, these guys have a great pitch, but it is all priced in, right? 15 times EBITDA is where you start getting when you've got a very good company. So I just want to ask, you pitched this because you guys think the IRR here is, way over 20% for the next 3 years. When people look at it and say, hey, this is a full multiple, what do you think your variant view is that kind of generates alpha here? And I'll let each of you talk if you want, or whoever wants to handle that.
Yeah. I think maybe just high level on valuation. Obviously this was hotly debated, on our side internally. And I think first off, it's important to note that we don't have a big, a long track record for what this thing has traded at, in its current business form. Again, it was only in 2023 when they spun off the global products business. So we don't have multiple cycles worth of history on the relative valuation that this thing has gotten. So, I think that's important. And then, it's lumped in a lot of times with automotive services and automotive retail. And, we at a high level don't think that is the right business model to compare it to. I think we have business model peers that we tried to benchmark it against, including franchise concepts like Hilton and Planet Fitness and Restaurant Brands International. And then again, since they do have a higher mix of company owned stores, throwing Starbucks into that mix. And Snap-on, I believe, has half their business has some franchise component as well. So we just tried to think about it more, with a broader perspective, in terms of valuation. And then thinking about the multiples that those business model peers get versus kind of the algorithms that they imply. And Valvoline has, much faster EBITDA growth and in comp and unit growth and EPS growth algorithm than a lot of these concepts. So going back to the valuation, I think if anything, 14 times EV to EBITDA, which is what we assume in 2027, is almost conservative, just given the algorithm that you're paying for today. So I think going back to your question in terms of what's driving a lot of this, I think it's just underappreciation of the durability of the EPS growth algorithm going forward.
Yeah, I think just to follow into that, I think you have to separate, what the multiple you're looking at is and what the underlying fundamentals are going forward. And so I think you look at the underlying fundamentals first, and you can see, a mid-20s EPS CAGR for 5 years, 40% free cash flow per share CAGR for 5 years. And then you take a look at, okay, I'm paying, let's call it, I think it's like about 25 times, depending on what your forward number is. It's like, that actually doesn't seem that unreasonable if I'm going to be able to CAGR EPS for the next 5 years at that rate. And then the question really becomes, okay, what's the back end growth rate and what's the multiple I want to exit at? So if we assume to get to a market return, let's call it 10% in this investment, it's a 15 times PE in 2027. And so if we assume it's 20 times the exit or 21 times, we're probably, to get to market return, you probably got to play closer to 30 times today. And so the second one we backed into our exit valuation with Jared was that take a 12% discount rate, assume the next 5 years after our discrete growth rate, and then I think it's like a 3.5 times terminal value, gets you to our exit price of $84, which I think, a stage 2 7% growth seems pretty reasonable, given there's still going to be about 15 to 20% store count growth left in it, and you're still going to have the top line, some form of same store sales growth, and you're throwing off so much cash you don't even know what to do with it, and you're buying back shares. I think you can easily back into a 7% EPS growth going forward.
And we did try.
Let me just ask Joe the question a slightly different way. So the market thinks 15 times EBITDA, thinks this is a good business. Where do you think your view versus the market is most divergent? If I just put the math away, do you think it's, hey, the market is a little more skeptical on the unit count? Do you think it's the market's a little more skeptical on the sustainability as all the ICE things we came in? Like, where do you just think your view is the most divergent from the market?
I mean, it certainly is a combination of, I think, what Jared mentioned around maybe thinking that, management guidance is a little too optimistic and this growth algorithm is not quite as durable. But, whenever we've spoken with investors about this name and they're reluctant to get into it, it really comes down to that EV risk. And we kind of parallel pathed it. We've covered it a lot on this call, on this episode. But, we really think that, it's a bit of an illusion and that it's long dated. And that's something that is difficult to, to convince others of. It's an unfalsifiable risk, but we really do feel as if, as Garrett mentioned earlier on, this, their asset is their density of bays and their technicians that will allow them to transition over to providing EV services and essentially take on that opportunity when the EV car park starts to be, at scale, essentially.
That makes total sense to me that the ICE hang up, because as I walked you through the math, that was that, and just saying, hey, I'm paying 15 times EBITDA, and I've started to have it beaten out of my head, but there is still the old value investor in me that says, hey, you want to buy stuff for 10 times price to earnings, like that's the metric, and it's tough to get that.
Guys, we did try to triangulate all this with like a DCF based approach, and as Garrett talked about a little bit, but again, like even if you just assume that unlevered free cash flow grows kind of inflation plus and assume their current cost of capital, you're able to back into like a 15.5 times implied forward EV to EBITDA multiple today.
This was great. I think we're gonna have to wrap it up here. But I just want to say, this was great. There's going to be a link to the deck in the show notes so people can see that. On page 22 of the deck, it includes all of these guys' emails. So not to put your emails out publicly, but if anybody wants to reach out to them, their emails are there so you can follow up with them. Unfortunately, if you're looking for interns, not only do all of these guys have internships lined up, I think it's Jared who has 2 internships lined up. So you're not going to be able to wrap these guys up. But look, this was great. Congrats again. And, hopefully looking forward to having all of you on in the future. We'll keep this conversation going. But congrats again, guys, and we'll talk soon.
Thank you for having us.
Thanks.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.